This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 92 was recorded on February 3rd, 2020. I'm Eric Townsend. This episode of Macro Voices All-Stars is brought to you by TopTradersUnplugged.com, the leading podcast when it comes to quant and rules-based investing. I'll tell you how to claim a free copy of their new guide to the best investing books ever written at the end of this episode. Returning once again is Alhambra Investments Chief Investment Officer, Jeffrey Snider. And as always, it wouldn't be Jeff Snider without a slide deck. Listeners, you'll find the download link for the slide deck that we strongly encourage you to download ahead of listening to this week's podcast from our homepage at macrovoices.com. Just look for the download link in the description of this article next to Jeff's picture. Jeff, it seems like there's widespread misunderstanding about what's really been going on since last September. Now, we had the whole world pretty much in agreement back in August. Oh boy, the U.S. yield curve is inverting. Everybody knows what that means. Has to be a recession just around the corner. 5 months later, so far, we don't seem to have any recession. So I'm not sure if we dodged that bullet or what. So whatever bad that was supposed to have happened to the bond market hasn't happened. Of course, we've got this coronavirus scare, but that could not have been anticipated by the bond market. So was the bond market actually anticipating something that's still going to go wrong, or was it just a scare, a monumental blip, or what?
Well, yeah, I think that's become the official narrative, Eric. And you hear it all the time. Not only that you can feel the growing confidence within policymakers as they say these things. You know, Fed Vice Chairman Richard Clarida, for example, as I'm showing on slide 3, he was in New York last month and he said, you know, the U.S. is in great shape. There was some stuff last year. You know, we did 3 rate cuts, what he called the shift of monetary policy, and that's all it took. But notice what he also says. He specifically uses the terms global growth headwinds and global disinflationary pressures. The vice chairman isn't just using them to blame all our problems on someone else. So that's probably one of the points he wants to get across. What he's saying is that the global economy was tripped up and the U.S. economy got caught up in it.
It was the U.S. dollar that had tripped up the global economy, right?
Yeah, and the dollar is the global disinflationary pressures, which then became these global growth headwinds. And the bond market knew it, which is why yields plunged and curves collapsed the way they did. In fact, the bond market was pricing the scenario all throughout 2018, not just in 2019. When you look at the curves and how they behaved in 2019, though, you have to understand something about inversion. It's not just one spot or another. Most people only pay attention to the yield curve when it inverts specifically between the 2-year and the 10-year, maybe sometimes between a 3-month bill and a 10-year note, because that's what all the academics have used going back to the 1980s when yield curve analysis first gained widespread notice. And in point of fact, the parts of the yield curve, and I'll tell you the very important parts of the yield curve, these had inverted all the way back in December of 2018. And it was actually the second very strong warning of global disinflationary pressures.
Okay, Jeff, but there was a family of curves that inverted before the American version, the global one, which is Eurodollars, right?
Yeah, the Eurodollar futures curve had inverted as far back as June 2018, and it was the same thing. Global disinflationary pressures, which people like Richard Clarida dismissed as nothing. These were monetary deficiencies that became what we saw in repo, what we've seen in swap markets, the rising dollar, all these other factors. In the summer of 2018, FOMC in particular dismissed them all as, the strong worldwide demand for safe assets, as if you wouldn't or shouldn't care why the whole world would suddenly start to strongly demand so many safe assets.
Okay, so that was the scare. Interest rates had plunged, curves got distorted, and then in August 2019, the one part of the yield curve that many people pay attention to inverted. And for a while, the business press ran with that. Everybody was talking about yield curve inversion at that point. Since then, has anything really changed? I know that all we hear about all the time is that it was a false positive. The yield curve uninverted. Of course, what they leave out is that the yield curve always uninverts. Usually if the recession is coming, the yield curve uninverts before the recession. But we had the yield curve inversion, the uninversion, so far, no recession. So I don't know if it was a pessimistic warning, or how do you see this?
Well, let's start on slides 4, 5, 6, and 7 here. You can see how the yield curve has changed over the last few months, going back to when it first started to invert in November of 2018. And so when you look at what has actually happened to the curves, you're much less impressed. I mean, much, much less impressed than the mainstream narrative. Now, I understand how it can be confusing. Most people don't follow the bond market or the yield curve, and the only thing they really know about it is the August inversion. So it seems like a big deal when that happens. The curve inversion is implicitly assumed is to signal, as you said, imminent recession. And then apparently the curve changed its mind. It was, everybody seems to think it's an all or nothing, one or the other. And, that's a mistaken impression, largely due to economics. Central bankers and economists just don't understand bonds. And it's really weird that they don't, because that's the reason why Alan Greenspan had his conundrum, actually more than one. And that's why so many misconceptions about the yield curve never get cleared up. Now, the yield curve itself is many different pieces, and they can often tell you different things, especially in the way that they move, or in this case, they don't really move. When you look at the way the curve changed from late August, say, to the end of October, when the Fed did its third rate cut, it is flattened out, as you pointed out, Eric. Sure, yeah, absolutely. But, it reverted so that it didn't seem so menacing as it was when it was all over the financial media in late August. But the only reason for that was the Fed. Between August and the end of October, the FOMC obviously voted for those 2 additional rate cuts, which is now a series of 3. So the short end, where the Fed has the most influence, that went lower as policy rates were lowered.
Okay, well, that's what most people would call stimulus, right?
Yeah, no question. Even today, that myth largely stands in the public's imagination. So the Fed cutting rate cuts, everyone believes that's a big help to the U.S. economy. And not just the Fed either. Remember, the central banks all over the world have been cutting rates, and the ECB even relaunched their QE. So there was a lot of monetary policy, quote unquote, dovishness at that time, which absolutely helped sentiment and helped frame this more positive narrative. But notice what's missing here, at least in the yield curve context. Again, slides 4, 5, 6, and 7. The back end of the yield curve, even the middle or belly, not just up until October, but past October into November, December, and now January, the curve never actually steepened. In actuality, as you can see it in a wider historical context, it barely moved outside of the rate cuts. So it was a very small backup in the longer term and the middle yields that was completely at odds with this idea that, powerful stimulus has helped the global economy and the U.S. economy in particular get past the recession scare. And so now we're in 2020, and we're back to the same kind of inversion as what had developed in late 2018. Those very same places on the curve, that front middle part.
Okay, Jeff, hang on a second here, because looking at your chart between the 6-month and 1-year bills, the part of the chart that you're highlighting, it never did uninvert the way the rest of the curve did. It seems like that was among the very first parts to be disturbed at the end of 2018. And from what you're showing here, it stayed that way even over the last 4 or 5 months, where everybody's been kind of saying, okay, false positive, false alarm.
Yeah, and that's on slide 8. Even in the one part of the curve that everyone jumped all over back in August, the 2s and the 10s, in reality, that piece hasn't changed all that much either, which is I'm showing on slide number 9. It's the rest of the curve that has been much more interesting. And what I mean is it's as much nominal levels as the curve shape. For all that's supposedly gone right, or at least gotten better in the world, why haven't nominal yields backed up so much further? In a lot of the same ways, we're right back at Alan Greenspan's conundrum. If the bond market agreed with the premise that rate cuts were a game changer and global dovishness is the reason behind what, Richard Collider was saying back, abating headwinds and disinflationary pressures, or even if those pressures were just dissipating for reasons that had nothing to do with any central bank, the nominal rates would have gone up much, much more than they did, much, much more. So, there were monetary policy changes, there's trade deals, the stock market was going bananas, Europe's QE, the Fed's not QE, all of these supposedly very positive differences, which we've been told turned the whole thing around. But the bond market just isn't buying it, not one bit. The yield on the 10-year Treasury never broke 2%. And because it didn't, that's the curve sticking around in pretty much the same shape as it had been in August, despite everything that's been said turned positive. Again, the only difference in the curve was those rate cuts, not the reaction to them. And that's an incredibly profound contradiction to the idea that these monetary and economic problems have been handled.
Okay, so what does that tell you about where things stand right now?
I think it's very consistent with the actual state of the world. The curve is. The bond market and the economy remain very much in sync. When you look at all the data from the yield and the money curve perspective, they line up, quite well together. So you begin by understanding the way the yield curve behaved in 2019, getting actually all the way back in November of 2018. It wasn't a one-time signal of inversion, therefore recession. It was the entire global bond market saying that the balance of risks had materially changed, and not in a good way. That these disinflationary pressures, because of the unabated dollar shortage that you and I, Eric, have been talking about for a long time, these were really starting to take their toll on finance and economic system. That's what you see in the data. For the sake of time here, I'll just use recent U.S. figures as my economic example, starting with slide number 12. Even in the latest GDP report from last week, the headline number was the third straight quarter of about 2% output growth. You can see how it has changed since all this curve stuff started showing up. But more importantly, the details inside the GDP report, which show that these last three 2% quarters weren't at all the same, even though the same headline number. The latest one, Q4 2019, for example, the only reason it got up to 2% was a 148 basis point contribution from an unusually large collapse in imports, the kind of negative change which suggests nothing good about the state of the U.S. demand. And that's on slide 13. And remember, that was the fourth quarter of last year, the one where everything was supposedly changed for the better. It was the quarter of all this massive global stimulus and rate cuts. Yet imports dropped at the fastest pace since the second quarter of 2009, which was the final one of the Great Recession.
Okay, hang on a second, Jeff, because since you're painting kind of a picture here that things are not as good as people maybe think they are, I think we need to be super clear about exactly what you are and are not saying. So you are not saying that the U.S. economy was actually in a recession at the end of 2019, let alone a really bad one, like say, comparable to 2008 and 2009. Is that right?
Yeah, I'm not claiming that the U.S. fell off a cliff last year. By highlighting these figures, I'm trying to do two things. The first, as I said, is to show how the data lines up with changes in the yield curve, including the more recent months when the yield curve didn't actually change all that much. That would suggest, contrary to popular claims, the U.S. economy didn't change all that much either. So at least not toward the positive or the rebound side. And that's the second thing. When you see figures like GDP imports, it totally cuts against that idea. Whatever that means as far as recession or the ultimate depth of whatever downside we're seeing, it's one data point at least, and a very important one that says, nope, definitely no upside. So there's plenty to still be concerned about.
Okay, Jeff. So it wasn't just imports in the GDP that were concerning. I'm guessing that there were other indications that you're seeing that things are going the wrong way.
Yeah, imports are just where it started. The reason they fell off so much was because the domestic part of the supply chain is just stuffed with too much inventory. If you go to slide 14, according to the BEA's estimate, there was practically no change in inventories after a huge increase in them during the 3 quarters before that. And the lack of inventory growth sounds like it might be a good thing. But in the context of an inventory cycle, and historically that's where recessions begin, that's what you expect to see at the top of it. Businesses end up holding too much. They begin scaling back. And they cut back what they order, and therefore producers end up making fewer goods. And in this case, fewer of them get shipped into the United States. And the reason inventory had been piling up was simply slowing sales. If you go to slide 15, for example, whether you specifically look at the goods economy indicators like retail sales that showed a serious slowdown in late 2018, or here in GDP terms, using personal consumption expenditures, which also includes spending on services. PCE in the fourth quarter, it grew by an annual rate of just 1.8%. So it's widespread softening, not a collapse, but material weakness that extended into the fourth quarter.
Okay, Jeff, if consumers weren't spending, then in all likelihood, businesses were not investing.
Yeah, for Jay Powell and Richard Clarita, and this is on slide 16, it should probably be the most disconcerting part of the whole GDP report. In GDP terminology, the CapEx for the supply side investments called real private non-residential fixed investment. And you can see on slide 16 how it's been down for now 3 consecutive quarters, including the last one of 2019. So it's another one which is pretty unambiguous about the state of the system. Maybe it's not recession, but it is questionable at best. And that's really all the yield curve has been saying since August. The downside risks have not disappeared. They're still there. The data shows there's a reason the bond market hasn't made much of the supposed improvement, because it is lacking in all of these places, and all these really key and important places. There are very serious issues indicated by just in the GDP data, which was supposedly pretty decent and strong. And there are estimates which include, the this time period in question that we're talking about, the fourth quarter of 2019, which supposedly was all of this positive stuff taking place.
But bond yields and curves don't just tell us about what already happened. Now, I know that a lot of people think the stock market is the market that best discounts future expectations. But frankly, I don't buy that. I think if you look at the historical data, the bond market has a better track record with respect to being able to forecast or anticipate economic conditions. So, Jeff, are bond yields, as we look ahead, indicating the same questionable circumstances are likely to continue, or perhaps even go with a little bit more downside beyond what we've seen so far?
Yeah, and as I said before, you can line up the yield curve changes with changes in the data from economic accounts all over the world. And like the lack of movement in the yield curve over the last 4 months, there are any number of leading indicators which suggest we haven't hit bottom yet. Whatever the bottom that might mean, the balance of risk continued to be negative. As I'm showing you on slide 17, something called the Duncan leading indicator is one. And I wanted to mention it here because it's derived specifically from the parts of the GDP report. The basic idea behind it is to isolate the cyclical pieces or variables, and therefore it's a ratio of GDP's cyclical components, therefore possible cyclical changes. Now, the yearly change in the index has been increasingly negative in each of the 4 quarters of last year, which is consistent with how the yield curve behaved. And there are many others. If you go to slide 18, I'll just show a couple more. The ISM's manufacturing PMIs. These are measurements of manufacturing sentiment that are importantly at very low levels and sticking around at very low levels. These are forward-looking indications that however soft the economy might be today, it's not changed, and the direction is most likely toward more softening, whatever that ultimately means. If you go to slide 19, even the labor market data lines up with bonds. Not the unemployment rate, obviously, but substantial, meaningful slowing in hours, job openings, even the headline payroll figures for the establishment survey. Taken together, they all indicate the same things as bond yields, and they're doing so at largely the same times. So the economy is, at best, highly suspect. Now, that would suggest the risks remain in balance, more to the downside than any kind of meaningful upside. And that would explain the bond market looking ahead from August 2019 to today and past today. The curve hasn't changed much because the situation hasn't really changed much. Not for all the QEs, rate cuts, trade deals, stock prices, whatever else that was supposed to have gone right.
Okay, Jeff, we know that Chairman Powell doesn't see it that way. He has expressed great confidence in the U.S. economy, and he's not just expressing it, he's acting on that confidence. So should we pay attention to the fact that the FOMC has stood pat for 2 meetings in a row now? Now, a lot of people see that as a very good sign. The rationale is if the economy wasn't getting better, or if these disinflationary pressures were still growing, then surely the Fed wouldn't have stopped with just 3 rate cuts.
Well, the only reason Powell's FOMC stopped at 3 was because there were historical precedents for a single series of 3. That's the 1998 case or the 1995 case, which is what Powell would like everyone to think is going on here. The more common historical precedents, however, is that these guys are just totally winging it. They're totally making it up as they go. If you go to slide 22, you only need to look back at the last time the Fed was cutting rates to see what I mean. It's been overshadowed by many other things, but people forget in 2008, the Fed paused in much the same way they're doing right now, in the middle of 2008. There had been substantial rate cuts from September 2007 to the spring of 2008. And then after Bear Stearns, Ben Bernanke and his Fed really did believe they'd gotten ahead of the crisis. Maybe they're a little bit late getting started and getting up to speed. But by April and May 2008, they felt, that was the end of it. That Bear Stearns would ultimately be the bottom. And so much so that by May and June of 2008, officials were talking about the U.S. economy, maybe even avoiding recession altogether. And I'm not making this up. You can read the transcripts from the FOMC meetings in that year. And actually, I would urge people to do so so you can see how they really have no idea what's going on. So, back in 2008, there was this one quote unquote final rate cut at the end of April 2008 they did just for good measure. And then for the next 3 meetings past that, throughout the whole summer of 2008, right up until the panic, they did nothing. They said things were looking up. Therefore, it didn't require any more moves to the federal funds or anything else that they were doing. So for 5 months in the middle of 2008, that was the official position, while over here in reality, it kept getting worse all the time. So that by late 2008, all hell broke loose. Now, again, let me be clear. I'm not saying that we're repeating 2008 or if there's anything like that situation in what we're seeing now. All I'm getting at is that, Fed officials or any central bankers anywhere else around the world, they're very prone to making these same kinds of mistakes. So the fact that Jay Powell has stopped cutting rates doesn't mean anything. Bernanke's Fed did the same thing right in the middle of the Great Recession. And policymakers haven't gotten any better reading the economy. I mean, they've proved that over and over again, which is another factor in the bond market behaving the way it is. So to begin with, officials, they know little or nothing about what they call headwinds and disinflationary pressures, which is really why the dollar moves the way it does and what that does to the whole global economy. And don't even get me started on repo, because that's still a part of this. I'll end up getting in a long-winded diatribe about sponsored repo.
Well, Jeff, I have a feeling that our listeners would love to hear your long-winded diatribe about sponsored repo, but that sounds like a podcast unto itself. So I think we're going to have to leave it there in the interest of time. It's great to have you back. We'll look forward to another update in a month or so. This episode of Macro Voices All-Stars was made possible by TopTradersUnplugged.com, the leading podcast on quant and rules-based investing. Be sure to claim your free copy of their recently updated guide to the best investing books ever written at TopTradersUnplugged.com/macro guide. And if you haven't heard it yet, be sure to check out my full-length interview with Niels Kastrup-Larsen on trend-following strategies, which is linked in your Research Roundup email. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.